All right, welcome back to episode 5 of the More Doors podcast. Today, we are going to be talking about how to develop your buy box criteria. We're going to get started right now. All right. Episode 5. Hopefully you guys are loving the More Doors podcast. If you are, show us some love. Leave us a review. Tag some people in it. Send it to it. And today's show is brought to you by our sponsors, Deep Blue Capital. Just go to deepbluecapital.com. So deepbluere.com. If you're wanting to check out how Deep Blue evaluates, looks at a certain property, certain assets. If you're looking to place, maybe you got some money sitting around and you don't know what to do with it. You're a little concerned with the stock market, a little concerned with just what's going on, and you don't have the confidence to go invest it yourself. Maybe you don't have the deal flow coming in. Go to deepbluere.com, where I know that we're looking at a lot of opportunities at this moment. We're underwriting a lot of deal flow. And so you can get on our list. Number one, when you get on our list, we will send out updates of what's going on with our current projects. That way you can see how we operate as operators and good stewards of your money. So go to deepbluere.com. Today, Matt, Brian, and I are going to talk about how to develop that right buy box. And there's a lot of operators right now. There's a lot of capital raisers and companies out there that are, I think they're just throwing spaghetti at the wall to see what's going to stick, right? Because they've created a company and they need money to come in, and they're just making offers on potential properties, potential asset classes that they have no business operating in. And so what we wanted to talk about today was how we here at Deep Blue have developed our buy box criteria so that we can stay in our expertise zone. So Matt and Brian, can you walk us through a little bit of how we developed this in the first place?
Yeah. Can I say something before we jump into that?
Yeah.
Brian's birthday is this weekend. Happy birthday.
Thank you, brother. I appreciate that. The first one to say
37?
36.
Still feels really old, though.
I think a year ago, like right now, you learned the hard way not to drink too much the night before a fishing trip.
Me and several other people did. But yes, I absolutely did.
Yeah.
Especially one that starts at like 6 in the morning.
Where did y'all go fishing?
Miami.
Yeah. Oh, yeah. I remember. Yeah, you don't go fishing hungover, especially out in the ocean.
Yeah.
Not in the real water.
I had never been like deep fishing before, but we definitely went and had ceviche and a lot of wine the night before and celebrated. And then my wife woke me up very early and said it was time to go. And I think I knew at that moment it was going to be a rough day.
Did you chum the waters yourself?
The bathroom downstairs,
Wow.
I did. Yeah, which made me feel exponentially better. The other people did not chum the waters, and they felt worse for way longer than I did. I bounced back pretty quickly.
You did, though. And honestly, aside from that, it was an epic weekend in Miami. We ate like kings and queens, and
tomorrow's Friday, dude.
I'm going to tell you.
Lots of Trulies at the pool.
Tomorrow's Friday, and I got tons of Marriott points.
Yeah? I mean,
You've got to change your birthday. Because it's too close to the 4th. Like we've got like 4th of July is like a family weekend for the Gershons and the Goods.
Yes.
And so like it's always hard. It's like, oh, Brian's birthday, Miami, this and this. Like we got kids, bro.
Nick's never come to my birthday ever.
Yes, I did. I went to the pool party during COVID.
Okay, that's fair. Well, that's during COVID and everything else.
Or it was 2019.
There's nothing else to do.
I think it was 2019. 2020's was canceled.
That is no. 2020's we still had it.
2023's was canceled.
Yeah, 2020.
Just saying.
But I'm sorry. I'll talk to somebody and see if I can get my birthday changed.
We'll talk to Diesel, Diesel and Peggy.
Exactly.
So let's break down this buy box, because I know that when we first sat down and talked about, all right, our meeting at breakfast about what were we looking for in a partnership, and a lot of these meetings just everyone goes and has business meetings. You start talking about opportunities, and usually nothing comes out of it. Right. And on this one, obviously, we three came together and started stating out what did we want for our futures. And there was a lot of synergy, a lot of alignment with what we were looking for. And we started developing where's our expertise. Matt obviously is the master underwriter.
Scary.
Yeah. Brian's more system guys. I have a really, luckily, thanks to my brother, I have a deep connection with a lot of people in this world. Yeah. Seems like every one that we made offers on, I probably know the owner,
the person,
the current sellers of it, or know something of it. And so we're able to go get a lot of research done. And so we started developing our buy box criteria of what we wanted to operate, and what we didn't want to operate. Number one is, as we grow this, we want to increase the cash flow. And not just go build something. There's a lot of these asset companies that are just building for net worth and future sales. And if that's all you're going for, what happens if you hit some roadblocks and you do all this work, and then all of a sudden that asset isn't worth what you thought it was going to be? Now you just worked for free, or maybe you worked and it cost you some money.
Yeah,
that sucks. So Matt, break down a little bit about how as we were going over this, what did you see and what did you like about the buy box criteria we set up?
Yeah, I mean, look, I think establishing a buy box is kind of a fluid thing, and it's also an iterative process. I think when you first get started in this business, you want to get into a deal.
Yeah.
And you're kind of price shopping rather than value shopping, and it doesn't matter what neighborhood it's in because you just want to break the ice. Or you have such rigid buy box criteria that you never buy anything because you're competing with institutions and hedge funds that have way deeper pockets and can afford less returns than you can. So I think it starts with the area, right? What areas are you comfortable investing in? Yep. What areas do you know? What areas can you get to? When I first started, I took my home address and drew a circle within 90 minutes of the house. And I said, anywhere within this circle, I'm willing to look at, because before I got smart about it, I was like, I can just jump in the car and go over there and fix things. Or if there's a water heater, I can go fix the toilet.
Already making bad habits.
But that's how I started, and it's worked, right? So I do think there's something to be said for a radius of influence, right? That doesn't necessarily work for everybody. I know guys that only buy deals out of state because they have a great network there. But you have to figure out what feels comfortable for you, and there's no two right or wrong answers.
Well, that's like you just said in like that last part, right? You know, people that only buy deals out of state, right? And that's their buy box. And it is an iterative process. You hit the nail on the head, though, is that there has to be iteration on something. And I think a lot of the path that people go down is like, this is going to do analysis paralysis.
Yeah.
They get like so in their own head about their buy box that they never end up doing anything. And there's a famous saying, right? Like, you can do anything you want, but you can't do everything you want.
That's right.
Right. And the way to kind of peel that onion back is like, you've got to have the awareness that like what you start doing, it's going to iterate, it's going to change over time. But if you don't start with something, then you're never going to get off the ground. And so just the idea of drawing a radius, 90 minutes from your house, why would you do that? Because that's action and you're doing something, right? Like you can find good deals anywhere, right? Now there's going to be, varying levels just on cycles or geographic areas and what's going on there and things like that. But there are deals everywhere. You can do deals for self-storage in Seattle. You can do deals for duplexes in Miami, Florida. But you could find them anywhere. But you've got to get off the ground. And so I think that not being so rigid with your buy box in the beginning, but just taking some sort of, this is my criteria and this is what I'm going to be doing, and then getting off the ground, that allows you to start to go, okay, we need to tweak some things.
That's right.
Right.
That's right.
Don't try to tweak things before you get going.
Yep. The other thing too is, and I think this is really important, is if you're self-funding your deals, or you represent a family office and you don't need to necessarily go raise money, you have fewer limitations than you do if you're someone syndicating deals and raising money and doing JVs. I would not feel comfortable making an offer on a deal that I intend to raise money for without seeing it first.
Yeah.
So, I think that 90-minute radius also helped me really dial in the areas that I knew I could get to on lunch.
Yeah.
Or after work before it got dark, or quickly on the weekends when I have my kids, right? Like those are all life criteria that you need to build into your formula.
Now let me ask you this. So let's expand upon that as the experience levels grow, and something will go down on our list here that we made up for this is that and your team evolves and grows, right? Your team of experts and professionals that you add, right? When do you start expanding out that 90 minute search radius?
Yeah, I think when you have a network of people that you trust that operate in those areas, and you can count on them for certain things. So if I'm looking at a deal and maybe I'm not in love with it yet, or haven't completed my underwriting, or I wanted to get another set of eyes on it, if I have a property manager that I trust in that area that can go do a drive-by or go do a tour on my behalf, and they come back and say, yes, this is good, or no, it's not, then I just save myself a bunch of time, and it's not inconvenient for them to do that, right? Yeah. And when you start to build your network like that, it comes back down the road, right?
Yeah.
So the other, I think a couple of other quick things on location, right, is I love to look at population data. Right? I look for at least 100,000 people within a 5-mile radius. The higher, the better. And if you just do a quick Google search for the town that you're looking in, you'll typically get metrics about what the population was like 10 years ago and what the population is now. And if you've seen significant growth, that's a good sign, because typically it may not keep up at that pace, but it also doesn't go negative unless something really bad happens.
Yeah.
Right? And hopefully there's no Chernobyl happening in North Texas anytime soon. And then I look at Google Maps. So I really like to look at Google Maps for a couple of reasons. One of them is I look for big box stores and franchises.
Success leaves clues.
Exactly. If you're looking at an area and there's a giant field with a sign that says future site of Home Depot, it's probably a good idea to get something there.
Pay people a lot of money to know where they should be.
Exactly. They've done studies on the demographics and the population growth and the income and all that sort of stuff, and you're just riding on their coattails.
It's funny you bring that up, because that's even on our Brian's and I's residential sales business. That's something we talk about buyers. Is like if there's a Starbucks nearby, you know that the area is either it's either an evolving and growing area, or it's already in that prime growth, because they're not putting a Starbucks where you're spending $7 for a cup,
right? Exactly.
Into areas of decline or areas that can't support.
That's right.
Can't support that. So I love that you do that. That's one of the reasons that in our buy box, like you said, that 100,000 population and the growth. What else are you looking for within that? Just let's expand upon population. What else are you looking for? Are you looking at the kind of income ratio?
Yeah. So I look at I use RealPage data, and I drill down into demographics for the zip code. Right. I'm looking for how the population breaks out by age. Is it evenly distributed, or is there for some reason a lot of younger or older people there? I look for income. Right, and not only am I looking at the income information, but I'm looking at how evenly dispersed it is or distributed it is. Right, so do you have a lot of people in that $25,000 to $50,000 bracket and nobody in the 6 figures and up?
Right,
because that'll tell you something about how your rent could potentially grow over time. Right. I also look at how income is growing. If rents are growing faster than the income in the area, and that's happened for a long period of time, you're going to price yourself out of the market, or you're going to force yourself to lower your rents over time, right? So I think those things are really important, and I think one of the key things is when you're looking at your pro forma rents, do that, take that rent, multiply it by 3, and then multiply it by 12, right? And do the people that live in that area, can they afford your pro forma rents? Don't do it off the actuals. Right, because what's great is I see these deals all the time. In-place rents, $800. Market rents, $1,200.
Right.
Then you look at the demographics, and nobody can afford the pro forma rents.
Yeah, exactly.
Right? So, I mean, it sounds great on paper, but can you actually execute?
I think that is, I mean, obviously that's such great advice. We get really, really, really excited about the pro forma. It just feels good to put something down on paper and be like, here's how much money we're going to make when we hit X, Y, and Z.
Yeah.
But, you know.
Paper rich.
Yeah, exactly. And this is why Nick is so valuable to this partnership. He's the biggest cynic on everything, right? You know, and
he's not.
He's the eternal non-optimist. and he's willing to do, like, the simple, logical math that every, you know, investor should do, and just go like, guys, there's absolutely no way we can pay this much because our rents are not going to be here.
Or
Exactly.
the problem that I see in most of these pro formas is that we're having to push rents to a capacity level that is not sustainable, right? It's kind of like in the flipping world on the residential side, is that when I see flippers trying to flip properties, but they base their numbers on the highest comp that they could get.
Yeah.
And there's just one.
Yeah, exactly.
And I'm like, well, you bought this based on that, and you're going to have to now sell it. You're now going to have to be the highest comp ever sold in that area. Yep. And the way that I see a lot of these deals coming out that's being underwritten is that we're having to always push rents to an extreme. And I was like, what happens? And this is one that Matt and all of us were underwriting another deal on. I said, well, what happens if we change the rent growth and lessen it? Let's say instead of it being 4, what if it was 2?
Yeah.
Does it still make sense of a deal? Because we have to stress test it and say, you know, when we bought the student housing deal, and saying one of the criteria or one of the routes that we took is what happens if there was another COVID type level. And it's like, can we sustain?
Yep.
What does that look like? Because this was straight student housing, and we're like, all right, luckily this area we shouldn't ever see that again, but here's our exit strategies if that happens.
Right.
And so as we're going through this, you're looking at population, you're looking at income, demographics, and looking for that trend line of hopefully growth.
Yep.
Not, we're not looking at a negative trend there, because if more people are moving out than coming in that area, we're probably going to have less demand in the next 3 to 5 years.
Yep.
When we're also looking at the type of asset classes, I know, when we're underwriting deals, I'll start to go feel out other investors and say, what are they looking at? Maybe they've underwritten this deal. Maybe they looked at it. Why did they pass? Yep. And there's a lot of investors that won't invest in certain asset classes. So I know that, for our buy box, Brian and Matt, if you want to break that down, is that we're not looking for just the worst Class C properties.
Yeah. Yeah.
And I know a lot of operators that love just plain in Class C.
Yeah.
And I know operators that love newer construction Class A only. Yeah. Because it's a different type of leasing structure, different type of clientele.
Yeah. I think, so before we switch over to asset class, the one other thing I just want to drill down on location is, once you know your macro locations and you're kind of drilling down to the property level, one of the first things I always do is put that address into spot crime.
Yeah.
Right. Go to spotcrime.org or whatever spot crime is. Yeah. And you get to see the crime in the area. Yeah. And when you see a bunch of those little red targets, I typily like to stay away from those.
Is there a certain, like, what type of crime though?
The little red targets are gunshots.
Oh, it is?
Yeah.
Okay. Yeah. I've never been to spot crime. So
oh, dude. Yeah. Okay. You'll see everything from assault to vandalism, theft, gunshots, the whole thing. And when you start to see them pop up, we passed on a deal that we were looking at, that was 110 or 120 unit a couple of weeks ago. I looked that address up, and it was like, whoa.
Interesting.
This is awesome.
It's a really.
You got to go to spot crime.
I will say that's new for me. Obviously that's something you were doing behind the scenes that I'm just now learning about, which I love. So spotcrime.com. Jesse's pulling it up right now. By the way, if you're liking this podcast, you're liking the video quality of this, check out Tor Studios. Just go hit up Jesse Strowalter, Tor Studios. If you're looking to create a podcast just like this, he'll definitely help you out on that. So let's go to asset classes then, because that kind of ties into spot crime a little bit.
Yeah.
You might see in Class C, there might be a lot more there might be a lot more red dots popping up.
Could be, right? I mean, typically those are older assets, more established towns, right? There hasn't been a whole lot of newer development coming into those areas. But it depends on your investment criteria. If you're looking for more cash flow and less appreciation, some of those areas may work, right? Whereas a Class A, because those were more expensive to build, especially lately, and they're being built with kind of the modern multifamily model in mind, with lots of fees and amenities and Wi-Fi and all that sort of stuff. There may not be as much cash flow, but there's likely going to be some appreciation, especially if you're buying it directly from the builder and taking advantage of preferential pricing.
Yeah, 100%. And it comes down to, obviously there's risk reward, and then also what you're comfortable with, right? There can be tremendous upside in every niche. Class C especially, you're going to have your heaviest lifts, right? So if you are going a little deeper in that niche, it's just you're getting your hands a little dirtier, but there can be potential upside if you really crush it. Or that's why institutions really love Class A, because it's stable. The returns are going to be a little lower, but the risk is heavily mitigated. So you've got to really dial in your involvement in the projects, and then sort of your risk reward there.
Agreed. And look, I talked to a lot of early stage investors, and I was talking to one a couple of weeks ago. And he said that he had never done a deal before, but he wanted to be in Class A properties in North Texas.
Okay.
And my first question was, how much money do you have or have access to? And he said, well, I know a few people with money. And I wasn't really confident in that answer.
Sure.
If you're looking to buy Class A properties in North Texas, right, you're probably looking at minimum $10 million purchase price, right?
Oh yeah,
for anything worth buying, right? Maybe you'll come across a 10-pack for $4 million or something like that,
right.
But those are big deals, and you're competing with experienced operators and institutions. So I think you got to kind of have a little lens of reality there. And if you're looking to get into your first deal, make sure it makes sense. Right, but don't get way over your skis, because the last thing you want to do is get awarded a deal and then not close.
No, you're
right.
Yeah, and I can speak to fact on that. I'm looking at selling off some of my. I have Class A, and it's in the mid 30s, and so it's a different buyer group, and it's family offices mostly, the institutional buyers that just want that stable assets. And where they can park money, there's going to be that future appreciation growth. They're getting some of the tax benefits of it. On Class C with heavier CapEx lift, is it more advantageous if you're needing, as an investor, that's a heavier tax write-off for them, correct? Versus a Class A, or is it going to be very similar?
The CapEx is usually deductible. I mean, you can,
but for having the K1 losses in the first year, so
the cost seg, you mean?
Yeah, the cost seg. So you should see a little bit more on those heavier lifts. Versus Class A's that shouldn't have it,
because you don't have a lot of CapEx.
Right. So you don't have a lot of CapEx. You don't have a lot of work that needs to be done on it, and so typically I would venture to say, not on a very far limb, just because I haven't tested this hypothesis, but your tax benefits as an investor are probably greater in the Class C style property that needs a little bit more of that CapEx budget. So you're getting those tax write-offs, and then that future value add and appreciation in years 3 and 5 when it goes to sell.
Could be. It sounds like we need to get Neil on this podcast.
I know.
Where's
right?
Neil?
Yeah, we'll get Neil. We'll definitely reach out to Neil and get him on. He does all of our cost segregation. And so that's something that we talked about is just the asset classes that we like to invest in. I preferably don't like to be in a lot of Class C. It's just it's a lot more. It's a lot more work. I'll take like a C plus to those Bs. All day. Class A is a little bit too expensive. We don't, that's not for what we're looking for, but usually that C plus type properties.
I think I go by like a 2 or 3 strike policy too. I'm not so concerned about 60s or 70s vintage if it's in the right area. Right. If we're talking about a 60s or 70s build in Richardson, I'm still very interested, right? If you're talking about 60s or 70s build a mile east of 35 in Fort Worth, probably not, right? So there's always qualification criteria. The other thing is, how is that property structured? So does it have a central boiler chiller? Because those are really expensive. I don't even know if they make parts for some of those things anymore, right? Yeah. So one of the things goes down, your whole complex goes down, and you get crazy calls for heat and water when that boiler chiller goes down, and it's crazy expensive. Yep. So if I'm looking at 60s build with boiler chiller and then like a flat TPO roof, I'm typically walking away for
throw
those.
One more in there.
Go ahead.
And that's cast iron pipes.
Yeah.
I mean, the deal that we walked from in Waco, the plumbing alone would have been $350,000 to $400,000 to replace the cast iron piping. Yep. And when you start to do, which you're like, the broker at the time is like, yeah, but some of it's already replaced. And then as you dig deeper, they've already started having plumbing issues.
Yep.
And so you start weighing the pros and cons of like, all right, that's a future problem. Could we build it in? And could be a value add. We take off the price. But if you're not willing to do that heavy lift right then and there, you're now going to have the constant, consistent maintenance calls of clogged toilets.
Yeah. Yep.
And what is that going to do for tenant quality?
Yeah. That's right.
And you have to be able to kind of future cast some of the other hidden costs of things like that, right? Like, let's just say it's $350 to replace all the cast iron plumbing, but it's not really $350 because you're going to have economic vacancy issues as well, because you're going to have to make some, you're going to have to make some people happy when those plumbing, like when you're going through the process of turning over all the plumbing and things like that. So it's going to cost you more.
It is. And here's the thing about plumbing. It doesn't drive rent growth. Right, and I think
it's expected that your plumbing works.
Yeah. Exactly. You need to be able to flush your toilet and have your sinks work.
Just like having electricity.
And that too, right? Exactly. So, for me, like, if you're going to invest CapEx, roofs, shingles, look, that stuff needs to get done, but you need to make sure that the bulk of your money is being spent on things that drive rent growth, attract better tenants, and reposition the asset so that you're very early on positioning yourself for the next person to buy it.
Well, it makes that property look cleaner.
Yeah.
Cleaner properties, that looks well kept, well lit, fresh paint.
Yep.
As much as that sounds weird, just having a fresh exterior coat of paint, it's that curb appeal. For people that are like, oh, I'm going to plant roots down here for 12, 13 months.
Yep.
What is that? And we're asking $1,200 a month, and I could go down the road to another place that's $1,000 that looks like a dump. More than likely, I'm willing to spend the extra $200 because this place looks clean. It looks safe.
That's right.
It's curb appeal, just like on the residential side. You want to come into a nice place. Just exactly. Paint can really do that.
Yeah.
So bring up property type, because you know what I'm starting to see right now. There's a guy I follow on Facebook who's taking a lot of these motels and hotels and converting these into apartments, and there's a push for that right now, and it helps create a little bit more affordability in the marketplace.
Sure.
I think right now it could be a fad. I'm a little concerned. I wouldn't personally invest my money in that at the moment. I need to see a little bit more consistency with it. But the type of properties that we're looking at, like garden types or single, just single floors, or old converted motels, townhouses, high rises. Like, for us, I'm a little bit more traditional style. I don't know about you, Brian and Matt, but I like that more traditional style of, that way I know what we're getting into.
Yeah.
There's less surprises that should pop up.
I think that's a really good point to home in on, because we see this on the residential like flipping side a lot, and I always encourage people not to do these projects like flipping, right? Don't flip houses. Don't take on a real huge project unless you're totally sure of the upside, just because you think it's going to be fun.
Yeah.
Right? Like, there was an old house in Las Colinas right on the golf course that had like massive foundation issues. It was like a mansion. And you could just envision like putting like $500,000 into this thing and just making like the most beautiful home. And it was at auction, and we could have got it for a steal. And I was like, it's so much work, and if you can't sell it, like, it's a huge problem, right?
Yep.
So he didn't do it, right? Like, the best flips are single-story 3-2s. They're not sexy, they're really not all that fun, but they sell very quickly, and it's usually pretty cookie-cutter. You can get in and out really quickly. Do projects because the numbers work and because you're sure about your business plan. And that's, again, like that's why we haven't really explored doing, like, the hotel conversions and things like that. Like, it's just not part of, like, our business plan. but they can be really fun projects.
They can
be really fun. But this is also business, and you got to be really sure of what you're doing.
Absolutely.
So, staying away from stuff just because it seems really enticing. Make sure that you can execute the business plan.
Yeah, and I think there's a lot to be said for repetition in this business, right? And I remember a long time ago, I listened to this episode of Bigger Pockets, and they had a house flipper on, forget his name, and he said, I buy 3-bedroom, 1,000 square feet in whatever town. I only buy those, and every time I do a flip, I use the exact same materials as I used on the last ones, right? So he knows where aisle the materials are at in Home Depot. He knows how to order them, when to get them, the whole thing. Yeah. And I think when you take that type of philosophy to multifamily, you can scale very, very quickly, right? Jake Stenziano from the Jake and Gino community says all the time, there's riches in the niches. And if you are a scattershot and you're doing a garden style one day and a motel conversion the next, and you try and do a high rise, you're increasing your execution risk, and you're not really building any sort of muscle memory in one specific area. And I think that's really, really important. Yeah. I was shopped a motel. I was shopped an apartment complex that was all 1-bedrooms, and when I looked at it, it was clearly a motel conversion. Yeah. And I don't know, those aren't appealing to me. Sure. Right? Especially when it's right next door to another seedy motel that hasn't been converted yet. Correct. You think about the tenant experience and stuff like that, it's just a different type of investment. That property is going to be great for somebody. It's just not for me.
Yeah, 100%. You're already going to encounter enough new problems with every project you do. Changing the style every time is just opening yourself up for more new problems that you have to learn and solve. It takes a while to get off the ground when you explore new territory.
No, 100%, and that's why while we do storage, and storage will be an investment class that we have. We're really wanting to build our expertise in that. And we will have that in the future because we definitely love storage. We love student housing. I mean, the student housing, we can even with our current investments, we can see. I mean, the demand is there.
Yeah, absolutely.
And the upside growth is there.
And by the way, we're 3 months in and we're achieving year 2 rents. Yes. So there's that.
100%. Yes. Yeah. Yep. It's a good niche right now.
Yeah. So and then just having having our the upside and working our pro formas. So looking at, I know that when you do the underwriting, Matt, and then when we go through version 1,000, we're always looking at the rentals and the loss to lease ratios. What is it that are you looking for a certain, just as the underwriter, are you looking for a certain ratio there?
No. Honestly, I look at the deal holistically. By the time I'm halfway through putting the T12 info into the model, I'm starting to get an idea as to whether or not this is going to be worth my time to even finish. Right. First thing I do is typically sanity check the NOI from the T12 over the purchase price. Right. I don't mind buying a 2 cap on entry if there's a lot of upside.
Yeah, there's upside because the cap in isolation is meaningless.
Agreed.
Yeah.
Right. What's the rest of the story? So I want to see how income is growing. Are they getting crushed with vacancy, bad debt, etc. What I love to see, and I'm being super sarcastic here, is when I look at an OM and they're like, fix vacancy, or burn off loss to lease. Well, that's a tenant class issue, right? And that's going to take a while to do. How do you, and they could say, oh, just come in and clean out all the tenants and clean out all the bad actors. And that's expensive, right? And it takes a while.
It takes longer than 90 days. Like, you've got bad debt, right? So cleaning out bad debt, usually what we've found, takes 90 to 120 days. So 3 to 4 months of bad debt clean out.
Yeah.
And then you've got to get those make readies and lease back up. Plus you've got the other vacancies.
Yep.
And everyone only focuses on one singular item. Like, Matt, Brian, if all we do is clean up this bad debt, look, it's fixed.
You're like, if it was that easy, it would have already been cleaned up.
Yes.
You wouldn't be selling this asset.
Yeah. So, but people get so narrowly focused on these one things rather than like you said, Matt, and I want to hone on that, is you look at the deal as a whole, and then you're gonna find the gaps. And if there's enough gaps there that could be fixed with the right systems, the right team, the right operators. Because I will also say, like, usually what I'm finding in this is that there's hands-off operators that just get a report from their property management team, or maybe they own the property management, just send out updates to their investors. Then you've got hands-on, which I think we fall more in the hands-on category. And maybe there's not a right or wrong. I would much rather just have someone hands-on if they're doing the right actions.
Exactly. You know, I think probably one of the reasons why the three of us are hands-on is because of our experience outside of investing in real estate, right? Like we're business owners or P&L owners at some level, right? And you have to make sure that the ship stays on track, right? And whether that's marketing support or operational advice or lending VA support, right? When you're getting a lot of leads, like those are calibrations and adjustments that you need to make. And if you're not a hands-on operator and you're not seeing those signs early on, all of a sudden you've missed your vacancy expectations and your whole deal shot for a year. Right.
And think of it this way: when you're running this, like you said, it's a business. And you could have the best systems in place, the most phenomenal systems, but if you don't have the lead gen part down, then you're not going to get, number one, you got to drive lease. You got to drive the tenant growth, right? Or if you have the leasing side down, the lead generation side down, but your operations back end part sucks, it's like leaving the back door open and everyone slips out on the back door, and now you're losing money, right? You're probably bringing in people that probably should have never been a renter in the first place, or a tenant in the first place, because they didn't meet the right qualification standards. And so now you're just placing someone to make your occupancy look great, but if they only pay 1 month and now you've got them in there for 3-4 months before you evict them, there's a cost to that. And so what we have learned and always tweaking and working on is making sure that is in the restaurant world, is the front of the house talking to the back of the house. And are they using the same lingo and understanding? And that's something that, as we've worked with more property management companies, we've had to learn or get them onto our lingo so that we don't feel like we're just, what is the right word? Like going crazy, because we might hear one thing,
but you got to get the real scope of what's going on with
because we might hear one thing and we're like, oh, this is going well, so you kind of breathe and pause, and then all of a sudden, a week or two later, like, wait, it's not where I thought it was, because we misunderstood or we weren't using the same language. And so it's all relationship based, right? And it's making sure that as you grow this, that you've got the same team.
Agreed.
Because you keep changing it, then what happens is it all just goes to hell.
And I think exactly what you just said about change is really important to everything that we talked about today, right? When you identify your locations where you want to invest, and you know the neighborhoods, and you know the blocks, and you know the growth rate, and you know the demographic, and you know what's driving economic activity in the area, it becomes a much easier task to vet out whether or not a deal is worth pursuing or not, right? When you're changing areas all the time, it's hard to find a groove. You're changing areas, you're changing asset classes, you're taking this really scattershot approach, right? Be prescriptive. It's okay to say no. You don't need the deal that bad, right? And do things that you know and feel comfortable with.
There's riches in the niches.
There's riches in the niches. Thank you, Jake.
Riches in the niches, and you don't need the deal that bad. Like, there's always another deal.
Yes, there's always another.
Don't do deals just to do deals.
Yeah, I'm willing to walk away. I'm always ready. I'm always ready to eject.
He is always ready.
I don't care if it's the day of closing. If something goes a little wrong, I'm like, look, guys, we're ejecting.
Please don't ever do that again, by the
way. Sellers, when you're hearing this, please don't pull fast ones. And I don't want to call the ejection. I don't want to hit that eject button. So as we wrap this up, I want to talk about exit strategies. Because I like to go, like, one thing that Matt, you've learned about me is, like, what are our paths? Like, you can build this. You could pro forma the most beautiful path to profitability. Being the most paper rich that we could ever imagine. Then we go by that, and then real life hits us. And so it's like, all right, what does this look like? And I know we've done these on our calls of saying, all right, if things don't go our way, how long can we operate this? Or is this breaking even right now? And then get through this seasonality part so that we can get to the other side and get back into our, our right plan.
Yep.
And so what type of exit strategies do you like to look at? I know Brian and I, we look at guidance from you on that, and then we develop, we kind of develop and shore the plan up on that.
Yeah, I typically I approach every deal as if it's going to as if it's going to be a 5-year hold, right?
Yes.
I think these projects, I haven't gotten to a point personally where I can think about flipping them in 12, 18, 24 months. I know there's guys out there that do it. God bless them. But I think just the stabilization piece usually takes a lot longer than you think.
Do you think that there's still opportunity for 12 to 18-month flips like that?
I don't know. I think a lot of it was driven by quick cap rate compression back in 2021.
Have a lot of momentum.
Exactly. And you could buy a deal at a 4 and flip it at a 3. And, just that in and of itself increases your multiple exponentially, right? But I typically look at every deal as if it's going to be a 5-year hold. How are we growing rents? How can we keep expenses in check and or find ways for operational efficiencies? Can we appeal taxes? Can we reduce property management costs? All those sorts of things. And then, are we gonna take bridge debt down and refi? Or are we going to find community bank that's going to allow us to hold it? Or are we going to go agency? And I think the type of financing that you need, that the deal qualifies for, helps kind of round out the exit strategy. So, this deal that we did, we're on fixed rate for 3 years, right? And then we're on a floater for 3 years. So we set a 5-year expectation for our investors, but we were also very, very clear to say, if rates are up after 3 years, right, this could impact cash flow, or we may just decide to sell it and move on, right? Because if we hit our 3-year NOI objectives and cap rates, and we hit our cap rate projection, which I think was very conservative given the state of the market, they're still going to parachute out nicely. And I'm sure they're not going to be upset with us about getting their money back after 3 years as opposed to waiting for 5.
I haven't heard anybody complain about making money.
No.
I've yet to hear that. Usually they only complain when they're losing money.
Yeah.
So,
usually they say, I wish I had put more in.
Yes. Yeah. So if you're looking to put more money in, just go to deepbluere.com. Or if you haven't placed any money and maybe you're nervous, right? I know a lot of our investors are first-time investors in syndication operations like ours. And there's definitely some nerve because they hear all the horror stories, right? You hear about, my aunt's friend Sally invested her deceased husband's all their savings into this deal, and it wasn't real, and they got scammed. And I mean, I know that as I was talking to friends, I've had friends bring up like how they've invested in projects that then it turns out their friend actually never owned it, or they sold it and they kept paying in.
Wow. And
I'm like, it just dumbfounds me on some of this stuff that people do that, and unfortunately gives this side of the business a bad name.
Yeah. And
so what I would really say is like, get to know who we are here at Deep Blue, deepbluere.com. Go research us and set a meeting with all three of us, one of us, three of us at one at a time. Get to know who we are and how we want to make sure that we're looking after your money, right? Because our money's in the deal too.
Yep, exactly.
And just know that if we're out here looking at a project and opportunity, that we've looked at every angle on this of how it could go wrong. And we're looking for all the no's, and if we've exhausted all the no's and reasons to get out of it and it still makes sense, then we're going to bring it to you.
Yep.
100%. 100%, boys and girls.
Well, we got $30 million in LOIs out this week. That's pretty exciting.
I know. Hopefully it's only Thursday.
I know.
We got 48 more hours.
Squeeze 1 or 2 more in just for funsies.
Maybe for your birthday, we just take one down.
Ooh, birthday present.
We
Let's
should
do
get
it from the beach.
Or we get to 36 million for your 36th birthday.
Ooh, that'd be fun.
Yeah,
let's get both of them accepted.
That's a good idea.
All right, we'll be able to raise some capital.
You can buy mine for 33 million.
That deal.
Yeah. So, all right, deepbluere.com, guys. Join us every week. We have new episodes being released. We're on Facebook. We're on YouTube. We're on Instagram.
LinkedIn.
Not Instagram, not yet. I don't think we're on Instagram.
Technically, we have one.
Do we?
By
so
the
we're
time
on
you hear
Instagram.
this episode, we'll probably even have something posted.
I think that's what you
LinkedIn.
said after the last episode. Just saying.
Yeah, LinkedIn. And then just go to Deep Blue RE. Just sign up for the newsletter. Here's what I'll say. Sign up for the newsletter because this stuff gets sent out to you.
Yeah.
And then just share it. Reach out to us. Tell us what you like, what you don't like. Maybe you I had someone yesterday, really quick, because I have to run. I've got to go get an IV. I had someone yesterday for Brian and I's other show that says Brian sounds like Lego Batman.
I heard that the other day.
Yes.
Somebody told me that.
He sounds like Lego Batman.
Yes.
So, look, you're listening to this and you just want to give us real, raw feedback. Maybe we suck.
I gotta watch that movie and see if that's a compliment now. I've never seen Lego Batman.
You've never seen Lego Batman?
Yeah.
Good movie.
I don't have kids.
Yeah.
You guys see all the...
I don't think you have to have kids just to watch Lego Batman.
That's no, 100%. See, I miss a lot of things because I think they're for kids. I miss a lot of stuff that adults.
There's people that go to Disney World that have no kids.
Yeah, I think that's probably the best way to do it. Jesse's raising his hand. Your kids, aren't you? Don't your kids get tired a lot faster? And there's a lot of stuff you don't get to do.
Yeah,
they're very low to the ground, and it's very hot too, so they melt a lot sooner than adults.
Kids melt?
Well, yeah, just they overheat.
What kind of kids do you know?
Yeah, I don't know a lot.
Obviously,
Guys,
he has 0
I'm very
kids.
inexperienced when it comes to parenting.
Yes.
Like,
Clearly.
I don't use the right terms.
You know what?
I think kids melt.
And one time I was like, Brian needs to have kids. I'm actually glad that you don't.
Yeah,
because they don't
100%.
melt. They don't melt.
I can't tell you the amount of times, even just this week, when I've been talking to our colleagues and they've had things going on in the background, and they will say verbatim, "You've made the right choice."
Or you don't get that. You wouldn't understand. You don't have kids.
I get that. I also I don't have a lot of compassion for it because I'm like, yeah, I know.
Yeah,
It's a conscious choice that I made. Don't use the "you wouldn't know you don't have kids" as an excuse for your bullshit. You chose to do that.
All right, guys. Episode 5 of the More Doors podcast. Hopefully you enjoyed it. Deep Blue RE, our sponsor of this, deepbluere.com. And like I said, if you're wanting to make a podcast just like this, maybe you're needing some video content, some marketing ideas, get with Jesse Showalter over at Tor, T-O-R-E Studios, torstudios.com. We'll see you next time.
Word.
Bye.